Hello everyone, I'm Ronald Mehta and welcome back to marketing91.com. We provide management and marketing training to students and professionals worldwide through our courses, videos and community. This video is part of our comprehensive take on the gamut of human resource management. Let's start with the gamut of incentive plans. Employees who do exceptionally well at work are rewarded with incentives which might be monetary or non-monetary in nature. Bonuses or perks are two common forms of incentive provided to employees by employers. In fact, incentives can also be defined as payment by results. As stated by Yoder, incentives relate earning to productivity and may use premiums, bonuses, or a variety of rates to compensate for superior performance at work. Let's look at an example of Lego. Lego gives employees more vacation days and high bonuses. Lego's consumer sales during September 2021 amidst the pandemic witnessed a positive spike, that increase of 35%. Along with that, their operating profits more than doubled in the same period. Thus, Lego decided to reward over 20,000 of its employees with 3 additional days off and a top-up in their bonus in April 2022 as stated by Bloomberg. According to Lego spokesman, the rationale behind this move can be attributed as a token of respect and appreciation towards their employees who worked tirelessly during the pandemic. The kind move follows a pattern with Lego, which has a history of generously rewarding its employees. For instance, the previous bonus entailed a full month's salary. Moving on to the types of incentive plans that we are going to discuss in this video. Well, there are ballpark 9 of them. Let's take a stab at each one of them briefly, starting with the first one, piecework plans. The most popular individual reward scheme, piecework, is the oldest and has been around for the longest. When a worker completes a piece, they are compensated with a fixed amount known as the piece rate for each completed unit. Moving further, there are broadly 2 types of piecework, one being straight piecework. The term piecework typically refers to straight piecework on a generic basis, which calls for a tight ratio between incentives and outcomes regardless of productivity. Straight piecework is the type of incentive program where an individual gets paid a predetermined amount for each product they produce or sell, with a tight relationship connecting outcomes and incentives. On the other hand, you have standard hour plans. A standard hour plan is a method of compensation where a worker receives a base hourly wage plus an additional percentage for output that exceeds the norm for each hour and each day. The compensation is based on percent premium and is comparable to piecework payments. Moving on to the next, team or group incentive plans. A group or team incentive plan is one in which a productivity benchmark is established for a particular team or unit or group in a firm, and its contributors get rewards if the team or unit meets or exceeds the productivity standard. Well, there are advantages of team incentives. First, it enhances problem solving and strategizing within the team as well as fostering cooperation among the group members. It lessens envy, makes group members appreciative of each other and reliant upon one another, and fosters cooperation. Well, there are disadvantages as well. First, the remuneration of an employee might not reflect the value of their own labor and contribution in the work. Top employees might get demotivated because they are the ones who would put in a lot of effort vis-a-vis the others who haven't put in that much effort. Moving on to the third, incentive for managers and executives, mid-level and higher. The majority of companies base eligibility for bonuses on a number of variables such as job position, base income, as well as other factors for incentives for managers and executives. For instance, important occupations have a particular effect on profit. Many generally determine eligibility based on pay, job role, or degree of employment. Top executives typically receive bonuses that are larger in terms of percentage. Moving forward, well, then incentives depend on several factors, one of them being fund size. The sum of the bonus funds that will be made available must also be determined by the company. The percentage of profit that must be distributed is not governed by any strict guidelines. Next, the performance of the company. Selecting the actual recipients of individual prizes is the next job. For each qualifying position, the employer typically determines the target bonus. In addition to the target bonus, there could be a maximum bonus which could be double the target bonus. Moving on, the gamut of long-term incentives for managers and executives. Long-term rewards are also known as golden handcuffs. Long-term rewards essentially encourage executives to remain with the business by allowing employees to build up capital, typically stock options, that they may only withdraw after a specified number of years. Long-term incentives are frequently offered in the form of stock, cash, phantom shares, stock appreciation rights, and stock options, something that we'll discuss in our video on ESOPs in the HRM module. Moving forward, stock options. The ability to buy a predetermined amount of business stock at a predetermined price and at a predetermined time is known as a stock option. The decision by the executives to exercise their right to purchase shares at a future date at the current price results in a profit. It is presumable that the stock's price will increase and the executive will profit of it. Moving on. Incentives for salespeople. Sales commissions are an important component of incentives used in sales compensation systems. The majority of sales associates, however, earn a salary and commissions mix, while some received a straight pay. Moving on. Salary plan for salespeople. Some businesses provide sales associates with fixed salaries along with sporadic incentives like bonuses, prizes for winning sales competition, etc. Straight wages make perfect sense when the primary responsibility is finding new clients or prospecting. It also works for account servicing, for example, taking part in trade shows. The straight salary strategy encourages sales force loyalty and makes it simpler to change territory or transfer sales representative from one territory to the other. Furthermore, the biggest drawback is that a flat wage might demoralize sales representatives who have the capacity to work well and generate more sales. The other option offered to them is commission plan. Salespeople are paid based only on performance under straight commission schemes. The largest incentives are provided by these arrangements for sales representatives. Sky is the limit. High-performing salespeople are drawn to commission-based compensation because they can plainly see the results of their efforts. Nevertheless, there are several issues. Salespeople frequently disregard non-selling responsibilities, including maintaining small accounts that don't give them a lot of commission, concentrating on devoted clients, and pushing difficult-to-sell commodities in favor of high-volume commodities. What works best is a combination plan, that is a combination between a straight salary and some amount of commission for them. Salespeople are often paid by their employees in the form of salary and commissions package, typically with an appropriate wage component. A common incentive mix appears to be around 70% fixed commission and 30% incentives. In the event that the salesman does not make any sales during a certain period, this mitigates the danger of him or her earning nothing. At number 5, profit sharing plans. Profit sharing typically entails calculating a company's profit at the completion of its fiscal year and allocating a portion of that profit to employees who are eligible to participate in the earnings. The employees must put in a particular number of years of service and build seniority before they are eligible to take part in profit sharing. Well, the features of this particular program entail the following. First, the agreement is based on mutual, free consultation between the workers and the management, and it is optional. The payment may appear in the nature of cash, shares or future credits, or it could be in addition to the regular compensation that would often be granted to personnel in a certain circumstance. Employees must meet certain minimum requirements as stated earlier, such as tenure requirements and perhaps other service requirements that may be set by the administration. A formula that has been agreed upon and is to be used in all situations is used to calculate the quantity that will be dispensed between all the participants at the end of the year. Moving on to the objectives of profit sharing plan. First, to encourage cooperation among employers and labor stability. To stop wasting resources when using tools and materials. To foster a spirit of cooperation between employees and workers and to pique the interest of the staff in the business where he or she is employed. To draw in top candidates and keep them on board, thus lowering turnover rates. To promote financial responsibility among employees. To offer group members incentives for greater production. And finally, to ensure the safety of the workforce. At number 6, employee stock ownership plans. Eligible workers are given company shares at a discount to the market rate under the employee stock option plan. The entitlement of a qualified employee to buy a specific number of shares of stock at a future date at a predetermined price is implied by the phrase stock option. Longevity of service, contribution to the division or department where the person works, and other factors may be included in the qualifying requirements. The business may even allow the person to pay for the expense of the stock that was granted to them in installments or perhaps even advance money that would be deducted from their paychecks every month. Moving on. Before a staff chooses to execute or activate the offer, the shares that were allotted to them are often kept in trust and transferred to their name later. The staff is given the ability to become a part owner in the firm and take part in its growth through the stock option plan. It moreover aids in retention and increases their level of dedication towards their work. The impact of ESOPs leads to retention of talented individuals and reduces the issue of brain drain, as in people quitting your company and taking along the experience to another company. As discussed earlier, we will be covering ESOPs in a detailed video under the HRM module on the channel. Moving on to number 7, gain sharing. A gain sharing plan tries to boost productivity or cut labor expenses and distribute the resulting profit, often in the form of lump sum amount, to the workforce. The foundation of gain sharing is a belief that motivated workers would increase output by making better use of organizational resources. Scanlon Plan, Rucker plans and ImproShare are the three main categories of gain sharing programs now in use. ImproShare is an acronym meaning improved productivity for sharing. We'll discuss one of them, that is Scanlon Plan, at number 8. Well, the key points of gain sharing. First, decide on the overall goal for the strategy, including increasing production or cutting labor expenses. Next, specify the performance metrics you want to use. For example, use productivity measures such as labor hours per unit produced. Equal shares or equal percentages are two common approaches. And finally, decide on the frequency and method of payment. Common stock does occasionally replace the customary form of payment, sometimes though. Moving at number 8 is, as mentioned earlier, the Scanlon Plan. Joseph Scanlon came up with the scheme in 1937. The plan was created so that workers may contribute ideas for lowering operating costs, enhancing work practices, and participating in the rewards of higher production. Scanlon Plan comprises two fundamental components. First, financial rewards are put in place with the goal of reducing cost and boosting efficiency. A squad of departmental and plant screening committee is established to assess the cost-cutting recommendations by workers and management. For the strategy to be effective, a number of requirements must be met. Number 1, it works best when smaller number of individuals and employees participate. Often the number is 1,000 or fewer. Whenever there are steady product offerings and prices, the business is more beneficial. Effective supervision and positive working relationships are essential for Scanlon Plan to work. And finally, the leadership team must be very committed to planning, especially in the initial time of confusion. And finally, the formula for distributing benefits. So if a suggestion is applied and works, all workers usually share in 75% of the sharing. Moving on to the final, earning at risk pay plans. Employees who participate in earning at risk pay plans agree to jeopardize a certain part of their regular pay if they do not meet their targets, in exchange for the chance to get a greater bonus if they succeed. Earning at risk incentive schemes are created with the intention of improving performance, in part by putting the worker's basic salary at stake and inspiring improved performance at work. For instance, an employee agrees to jeopardize a certain percentage of his or her pay, say 6%, if they do not meet their targets, in exchange for the chance to get them a greater bonus, say 12%, if they achieve them. Finally, let's look at some characteristics of the various incentive plans. Incentives typically motivated the employees that fall under the purview of sales, but the gamut of incentives has also expanded to other departments. Both financial and non-financial components may be included in an incentive strategy. Timing, precision, and regularity of rewards are crucial for an effective incentive scheme. And finally, the workers' performance should be encouraged, feedbacks ought to be given, and redirection should be encouraged through effective communication of the incentive scheme. Next, we look at the prerequisites of an effective incentive system. We kind of got the flavor of this in the earlier part of the video, but let's put them in certain points. First, employee participation in the execution of an incentive program is crucial because if they do not like the program, they may devise cunning methods to get around it or even sabotage or destroy it. The performance expectation established must be attainable and must inspire employees to provide better work. Tools, supplies, and other necessities must be made available to workers in order for them to be able to reach their positions. Management should indeed be committed to the expenses and effort required to effectively operate incentive programs, and these ought to be thoroughly evaluated before adopting an incentive program. Planning is now more important than ever. Numerous incentive programs that have prematurely begun, haphazardly conceived, and implemented have collapsed and therefore have caused the organization more issues. Finally, the benefits of incentive plans to conclude the video. As workers develop responsibility and discipline, the requirement for surveillance decreases. As a result of greater salaries and management's enhanced productivity, the employee-employee relations are better. Thus, a culture of collaboration and teamwork is fostered among employees which works in the favor of the employee and the employer. So that's it, folks. This brings an end to a comprehensive take on the gamut of incentive plans. These are the list of sources and links referred to for our content in the video. Thank you and stay tuned for more videos.